Benefits of holding stocks for the long term. A long term investment strategy entails holding investment for more than full year. This strategy includes holding assets like bonds, stock, exchange, traded funds, mutual funds, and more. Individuals who take long-term approach require discipline and patience. That's because investors must be able to take on certain amount of risk while they wait for higher rewards down the road. Investing in stocks and holding them is one of the best way to grow wealth over the long term. For example, S&P 500 experienced annual losses in only 11 of the 47 years from 1972 to 2022 demonstrate that the stocks market generates return much more often than it does not. Long-term investment always outperform the market when investors try and time their holdings. Emotional trader tends to hamper investor returns. The S&P posted positive returns for investors for over most 20 years time period. Riding out temporary market downside is considered a sign of good investor. Investing long-term cuts down on cost and allow you to compound any earning you receive from dividends. Better long-term returns. The term asset class refers to a specific category of investment. They share the same characteristics and qualities such as fixed income assets or equities, which are commonly called stocks. The asset class that is the best for you depends on several factors, including your age, risk profile, and tolerance, investment goals, and the amount of capital you have. But which asset class are best for long-term investors? If we look at several decades of asset class returns, we find that stocks have generally outperformed almost all other asset classes. The S&P 500 returned an average of 11.82% per year between 1928 and 2021. This compares favorably to the 3.33 return of 3 months and 5.11 return of the 10 years treasury notes. Emerging marketing have some of the highest return potential in the equity market but also carry the highest degree of risk. This class has historically earned high average annual returns, but short-term fluctuations have impacted their performance. For instance, 10-year annualized return for the MSCI Emerging Market Index was 2.89 as of April 29, 2022. Small and large caps are also delivered above average return. Ride out high and lows. Stocks are considered to be long-term investments. This is in part because it's not unusual for stocks to drop 10 to 20% or more in value over a shorter time of period. Investors have the opportunity to ride out some of these high and low over a period of many years or even decades to generate better long-term return. Looking back to stock market returns since 1920, individuals have rarely lost money investing in S&P 500 20-year time period. Even considering setbacks such as Great Depression, Black Monday, and tech bubble, and the financial crisis, investors would have experienced gains had they made an investment in the S&P 500 and held it uninterrupted for 20 years. While past results are no guarantee for future returns, it does suggest that long-term investing in stock generally yield positive results. I hope you guys like this video. Don't forget to subscribe to my channel.